Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Thursday. It's April 14th. It's going to be a short week because we've got the long Easter holiday weekend. Now, it's about 8:11. I'm on to about a late start this morning. Market's going to open up in about an hour and 19 minutes to be exact with you. Now, as you can see here, everything is down just a bit, but we had a hell of a rally yesterday. And the fact that the market's opening down just a few points or is down a few points before a big report, which is going to be the retail sales, which I'll cover in a few minutes, it's not all that bad. I mean, we've been seeing volatility between 700 and 400 points on the Dow every single day. The good news is it looks like the market is finally starting to turn. We're seeing 3 even days on the long bond, and we saw a rally after the worst industrial production, or excuse me, not industrial production. It was the I'm losing my mind. It was the PPI, Producers Price Index. Industrial production is tomorrow, but PPI, which is a leading indicator, it was horrible. I mean, horrible. CPI, horrible. Market actually went down on the CPI after first half of the day, but rallied on the PPI yesterday. Also, and this is really instrumental, is there's a few things. Number one, and this is really important. If you look at my 11 sectors, if you look on a cumulative basis, energy, utilities, consumer staples are still leading. But take a look on a monthly basis. Consumer staples, basic material, consumer discretionary. Now, consumer staples is very defensive. Basic materials can go either way. But consumer discretionary being on the third spot, remember I told you it was going up. And it's not just that. It's also, if you look at the major, here it is, the heat map. For some reason, it likes to go lower. But if you look at the heat map, this is yesterday. Obviously, today hasn't started trading yet. Look at the top 2 sectors in the last 24 hours. That's saying a lot. That's telling us right now that the market is completely assimilating. Look at it on a 5-day. Consumer discretionary is here. It's not down there. And on a 1 month, let's see on a 1 month, it's right up here. I mean, look, you've got the 3 most defensive: utilities, consumer staples. The only thing that's missing is energies. And then you've got consumer discretionary. We can't ignore that. We can't pretend it doesn't exist. That's very significant. Now, with that said, the bond market has been kind of stable and it's oversold right now. There's a good chance we'll get a rally from the bond market. If that's the case, it'll relieve some of that increased interest rate pressure from the stock market, and it can cause a nice juicy rally. Now, with that said, put the call ratio is still inflated. We're still in the danger zone in terms of seeing upside because we are near the 1 level. Whenever we're near 1, you've got too many put buyers for call buyers, and that means the market can turn and become more bullish, which is a very positive sign right now. I'm still focused on basic materials because they are the closest to breaking out to all-time highs, and we had a nice little rally yesterday. I like basic materials, and I also like the consumer discretionary right now. I really do. And I know it's crazy, but I'm telling you, they've been rallying. And if we can go up to the 200-day moving average, we'll be doing well. The fact that they're holding up and they're not going down all the way is a very positive sign. Now, we do have retail sales this morning. That's a big report. It reflects 2/3 on the GDP. GDP makes up the economy. So if the number's really strong, then the Fed can say, hey, the economy is running too hot. We don't have to go crazy and do a 50 basis point rate hike. But if the number's really low, then they could say, hey, we really need to stimulate the economy. So it'll be very interesting to see, but this is the consensus, and these numbers are coming out in 15 minutes, right after you guys get this video, actually. In terms of volatility is just a little bit, I mean, we're in the middle of a war, and volatility is at 21 right now. That's a very positive sign. Let's take a look at world economy, and then I'll get into the nitty-gritty. China indicated that central banks will ease reserve requirements for lenders to counter the blow to its economy from the pandemic shutdown in Shanghai. And I'm praying to God that it doesn't make its way to the U.S. Markets in the U.S. and Europe faced a short week. It'll be closed for Good Friday ahead of the Easter holiday weekend. Easter is a huge holiday in the U.S. expect the market to be subdued today. It would be kind of weird if it was not subdued. Investors have appeared to brush aside fresh evidence that inflation remains widespread in the U.S. economy, according to U.S. government report that rising energy costs pushed wholesale prices up to 11.2% last month from a year ago. What did the market do? It rallied like crazy. The report followed news a day earlier that consumer prices remain at the highest level in 40 years. And again, what did the market do yesterday? It rallied like there was no tomorrow. Inflation may be peaking, which the market may be pricing in, but it'll likely stick around for a while as cost pressures filter their way through the market and ultimately to the consumer. That's how it always goes. Russia's invasion of Ukraine has risen volatility for energy prices and all other sectors and put people on high alert as oil supply was already tight as demand rises with the warning of a pandemic. As demand rises with the waning of the pandemic. So again, whenever you have the pandemic, energy prices are subdued, but now you have a potential rise in COVID, but you got this war in Russia. It's just a mess. U.S. crude prices are up 40% for the year, driving up gasoline prices and giving inflation a bigger hit on people's wallets. Companies in various industries have been raising prices to offset rising costs or increase margin. Investors will get more details on how companies and consumers are dealing with inflation as we have earnings. We got United Health, Wells Fargo, Citigroup, Thursday, today. It's going to be a big, big day. Financials are going to set their tone. Commerce Department will release retail sales and show whether consumers are pulling back on spending. If they're not pulling back on spending, it'll be very, very interesting. And again, that report comes out in about 12 minutes. Now, today's Thursday. Usually on Wednesday, I give you my top stock to the long side and to the downside, but I got confused and I did my ETF yesterday, so I'll give that to you today. My top stock is Kroger. I really like Kroger. I think it's a no-brainer right now. It's a low-hanging fruit. I think food prices are going to go higher in the next couple of months, not lower. And I think Kroger's going to see a big demand. And you know what they're going to do? Pass it down to the consumer. So I think we're going to see a little bit more upside or at least elevation in prices. So KR to the upside, I would buy around these levels, get out right near all-time highs, and put a stop loss right at the 50-day line. Then we have APTV. This is just to give you an idea of what this company does, it's a technology company, automotive sector, consumer discretionary, but look at the one-year return. Look at the 5-year revenue. This company, look at the 5-year dividend growth. This company is not doing all that well. They're doing terrible right now. And it looks like car prices are elevated. The stock has been congesting, and I think if it doesn't go up next few days, it's going to be ready to come down. So I'm pretty bearish on this stock, and I think consumer discretionary is a little overbought right now in the short term, although I'm still liking it quite a bit. But if we break below this right here, the 106 level, I would be selling this stock. And I would ride it probably all the way to the bottom. And if it comes back above the 50-day line, I would probably liquidate it. Overall, looking at the stock market, we went up 1% yesterday. We're consolidating around here. I think we're going to hit the 200-day moving average. The fact that we're not going all the way down is a very, very strong sign. And again, the fact that consumer discretionary is up 8.52%. Energy is only up 3.57% over the last month, but consumer discretionary 8.52%. Now, this is just the last 30 days. We can't really focus on this. We got to look at the cumulative, but even on the cumulative basis, they're not down here anymore. It's up here. It's starting to come up. So the fact that the markets are rallying on negative news, the fact that we have earnings and earnings estimates have been really, really low, the fact that typically under the current economic conditions, market actually rally for 12 months, there's a much better sign, in my opinion, that we're going to go higher than lower. Keep your eye on the 200-day moving average. On that SPY, let me just give you those levels. On the SPY, that level is 448.50. On the QQQ, which is we're kind of far away on the QQQ, that number is 370. And on the Dow, and I'm giving you the ETF variations of it. On the Dow, that level is at 35,000. 35,000. If we can get above 35,050 something, we'd be good to go. But I like how we're holding this this in line with the channel, and hopefully will remain in this range and go higher. Don't expect too much from the market today because we have a holiday. Typically before holidays or after holidays, markets are fragmented for a few days. But with the war, with all this Fed data, who knows? Things have been really crazy lately, right? So folks, it's hard enough to trade stocks right now without having to worry about all the noise, the volatility in the markets, right? Especially right now. Which is why I want to give you all the tools that you need to get ahead of the game as the market rotates out of growth stocks, potentially out of growth stocks. From what I'm seeing here in my consumer discretionary, we may be in growth stocks for a while. That's why I went live just a few weeks ago with one of my favorite rotational strategies, also giving away my number one sector play for the next 6 months. Click the link below to watch the replay and find out which sector to pay attention to right now. You guys are going to love this rotation strategy. It has a built-in hedge. It doesn't require you to sit there and watch the market. You only have to rotate positions every 2 weeks. The underlying assets and the options are dirt cheap, so you don't need a huge account to get into it. Click on the link below and watch and find out which sectors to pay attention to right now. Monday, week outlook, biggest threats, biggest opportunities. I'll talk to you guys later. Bye.